Let's get more on the impact of Trump's tariffs, particularly on US small and mid-cap companies. Chris Andrews from La Trobe Financial joining me now. Always great to see you, Chris. I mean, we do have US markets holding at or near records, but what has been the main impact here on the SMID companies?
So it's one of the great untold stories of the world economy, really, Juliette. And you know, people often, when you think of the US economy and you think of companies in the US and listed markets, you'll think of the likes of Google and Alphabet as it now is. You'll think of Meta, Nvidia. Back in the old days, you might have thought of Ford or General Motors or GE, all wonderful companies. But the beating heart of the US economy has always been this small to medium sector. And we call them small to medium. In the US, that means a very different thing. That can be companies with a market cap as big as sort of $50 billion. So they can be very substantial companies. They're often got significant family involvement and founder involvement. And they're doing a whole range of businesses across a very diversified economy. And in fact, often they're providing services to those really big sort of large cap companies that you're thinking about. So it could be everything from logistics to janitorial services to catering to very specialized technical and technological services, IT these days, but also in engineering across the whole range of disciplines. So it's a wonderfully vibrant sector. And the extraordinary thing in this sector, conventionally the assessment has been those sorts of companies will be more exposed to periods of volatility. And certainly the Trump tariff moves have been ones that many analysts have thought would put pressure on this sector, but they are standing up remarkably well.
Indeed. And, you know, we're looking so closely at all the major thematics, particularly when you look at what you saw from some of the big name companies like Alphabet saying, look, spending on AI is expensive, but it's worth it. How do you then sort of navigate opportunities in the small end of town looking at those thematics as well?
So in terms of looking at those companies, I know certainly our view has been here in Australia, Juliette, that what you need to do is think very broadly in your exposure. Choosing companies when you're in a period of transformation, there'll be winners, there'll be losers. It's very hard to identify who those winners and losers will be. And right now there's an arms race on AI. So if you're focusing in that segment, whether you're at the large cap space or whether you're honing in on the mid and small caps who will be iterating AI in a more targeted, more specialized way, it's really hard to tell who's going to win the arms race there. So we always like to look for broad exposures. In fact, you know, when we invest here at La Trobe Financial, we actually think that the private credit exposure to that small to mid cap space is the right way to go about the market, because you're getting that equity-like exposure to really strong returns, but you're removing the sort of the mark-to-market day-to-day volatility that you see in the listed space. And we think so for most Australian investors, that's a really sound exposure to that part of the market.
What are you looking forward to, or what will you be sort of looking most for in company earnings when we have reporting season kicking off in a couple of weeks?
So the effect of the Trump tariffs is occurring now and over the next 3 months. So it's, you know, folks have, you know, there was a lot of inventory building in late 2024 and early 2025 ahead of those expected announcements. So far the US economy has been particularly resilient, but those inventories have been starting to run down. So what we're looking now is for those parts of the economy in the US that are most exposed to those sorts of tariff and importing risks. So it's companies with significant exposure to international supply chains that you've got to focus on. And you've got to look at how they've been able to switch their supply chains to less tariff exposed countries, or indeed to bring those onshore into the US. And the one thing I'd say about the US, many decades shows never ever bet against the American economy. They are incredibly resilient. They are very used to seeing disruption and change, and they're very adept to navigating it. So my money would remain very firmly on that US small to medium part of the economy continuing to be what it is now, the third largest part of the global economy after the full US economy and the Chinese economy.
Yeah, don't bet against the US, as you say, Chris. The likelihood, though, that President Trump's bark is not potentially as bad as his bite. I mean, we've seen that with the trade agreement between the US and Japan this week. How do you factor that into looking for opportunities?
So as an investor, you really do need to take a longer term view, Juliette. We talk to our investors about all this time. No one knows how all of this is going to play out. No one knows whether, suppliers in the US, for example, will find ways to onshore, to work around those tariffs, to get their supplies perhaps from sort of countries that have more favorable tariff treatment, or whether actually it will cause serious disruption. There's a whole lot to play out, and that won't be solved probably for the next 18 months at least. So investors, I just say again, you need to be careful about putting all your eggs in one basket here. Look for good, broad, diversified exposures to the sector. Have confidence that that sector will thrive over time. Both sides of US politics are absolutely committed to, the phrase that launched Donald Trump's career was "Make America Great Again." And both sides of politics have adopted that as their own. They're absolutely focused on rebuilding this part of the economy, but picking the winners in a time of geopolitical tensions, policy changes, transformational technology developments, and you've already called out AI, Juliette. Those three factors mean choosing individual winners gets more and more complex from here on in. So focus on broad thematics, look at general diversified exposure to the sector, and you've put yourself then in a position for your portfolio really to flourish.
Are you surprised at the resilience of financial markets amidst what we've seen since April 2nd and all the global uncertainty?
Well, they do say markets climb a wall of worry, Juliette, and we've certainly seen that over the last 3 or 4 months. And I think what we're seeing now in investors is sort of they're getting very pragmatic. There is a wall of money to be investors, and investors are saying, well, we can't just sit on cash. We do need to deploy our cash to get reasonable returns. So whilst it's very hard to see who the winners will be, investors are, in aggregate, choosing to stay invested, and that is a vote of confidence in the US economy. So yeah, look, it certainly hasn't played out the way some of the doomsayers were projecting back in March, April, May. It certainly has been extremely resilient, but when you look at the wall of money that needs to be invested and will continue to need to be invested, Juliette, it's not to say there won't be periods of disruption. Of course there will, but I think into the medium term, investors are now starting to look through those concerns that they had.
What's your view on whether or not you allocate to crypto, particularly with Bitcoin, now the world's 5th largest asset?
Well, it has stood the test of time. So crypto is now sort of 15 years old. Bitcoin itself is now about 15 years old, and it has continued to, over time, grow. Now, I would say for any sensible investor, and we have a lot of investors in our business, Juliette, who are in retirement or nearing retirement, you still have to be eyes wide open that there is not a really strong use case on a day-to-day basis for crypto. It is still being a store of value, and what you are betting on when you buy it is you are betting on the fact that people will continue to regard it as valuable. It's not a cash producer. It's not serving a useful place at the moment in transactions in any sort of scaled sense. So you are depending on the fact that people will continue to regard it as valuable. If you're prepared to, if you like, use a bit of play money in that way, if you want to get exposure to the sector, then that's fine. But you just do need to do it with your eyes open.